Let's say you own 100 shares of DraftKings at the current price of $48.82. What if I told you that you could open a trade today where a week from now you can either sell those shares for $52, which would give you a 6.5% gain for 1 week, which equals 2,543% annualized, or you can just receive $100 if the stock finishes anywhere below $52. And this $100, you'll get it no matter what. So your gain in scenario 1 is actually an 8.5% weekly gain, which is a 6,855% annualized gain. So what's the catch? The answer is that there really isn't one. We can set this up with what's known as selling a covered call. So how do we do that? Let's get into it. Welcome back to the Hourglass Trader, where as time passes, we make money. So something we think is always helpful, let's first take a step back and talk about what is a call. And a call is a contract that gives the buyer the option to purchase shares of a stock at a predetermined price known as the strike price. So what does this mean for the seller of a call? As the seller, you have the obligation to sell shares to the buyer at a predetermined price, which is again known as the strike price of the call that we sell. And we explained how selling naked calls works back in part 1 of our credit spread series. So if you need a refresher on that, go ahead and take a moment to go back through that video. But long story short, selling naked calls can cost you a lot of money if things go against you. Here's a quick screenshot from that video where we talk about how selling a naked call on a stock that's trading at $100 could quickly move against you and result, as we have in this example, in a $92,000 loss. So long story short, that's why the basis of our strategy revolves around selling spreads and covered calls. We never want to sell naked calls. Those are the single riskiest move you can make in the option selling game. So with a covered call, the option seller already possesses the shares that they're required to sell. That's the sense that they're covered. The options that you sell, the calls that you sell are covered by the shares that you own. So let's take a look at an example. Let's say we have a stock that's trading at $45. So we own 100 shares at that price, and we sell a 50 strike call for a $1 premium. And we know that the $1 premium is multiplied by 100 because each contract has 100 shares. So we get $100 worth of premium in our pocket for selling that 50 strike call. So again, looking at this 50 strike call at a fundamental level, what are the possibilities for this call? Well, if you've been following along with our series, you've probably got this down by now. You know that if the stock finishes below $50, we're going to hit max profit because nothing happens and the buyer's not going to exercise a worthless option. But what happens if it finishes above 50? We talked about in our naked call example in our credit spread videos, that's when you start to get in a little bit of hot water. However, since these shares are covered, all that happens is the call is going to be exercised and you're just going to sell the 100 shares of stock, which you bought at 45, to the buyer of that option for a price of $50. So from a profit and loss perspective, let's take a look at the 100 shares of stock that we bought for $45. That cost us in aggregate $4,500, and we turned around since those calls that we sold are exercised and sold them for $50. Proceeds from that, $50 times 100 shares that we sold, give us $5,000. And pretty easy addition from there, our profit results in $500. And that was kind of just a little bit more of a long-winded way of explaining where that profit's derived from. If you're kind of following what we're talking about as we go through this presentation, you'll know that we bought the shares for 45. In plain English, we sold them for 50. It's a $5 gain a share. It's pretty easy to calculate. But that kind of begs the question, when is it a good idea to sell covered calls? And the answer lies in implied volatility. So what is implied volatility? By definition, implied volatility is the market's forecast of a likely movement in a security's price. IV is often used to price option contracts. High implied volatility results in options with higher premiums and vice versa. We've got higher premiums in bold, we've got it in green, and we've got it underlined because higher premiums are exactly what we look for when we're selling options. The more expensive the premium, the more money we're going to make. The higher the implied volatility, the more premium. So we like stocks with high implied volatility. But there's something else in the implied volatility discussion that we want to talk about, and that's IV rank. So what is IV rank? A lot of people do not mention this in the scope of implied volatility, and it's really important to mention as we go through and evaluate what options to sell. IV rank simply tells us whether implied volatility is high or low in a specific underlying based on the past year of IV data. So what does that look like in plain English? Well, if we have a stock where the IV percent throughout the year peaked at 70 and hit a bottom at 50, and the current IV was 60, we would know that the IV rank is 50%, and that would tell us that it's dead in the middle of where it trades at. So why is this useful? If you're running a scan or looking at different stocks and different options to sell, you might come across something where implied volatility seems really high. You might see something that's 200 or 300%. But the question that you really should be asking after you see that, is 200 or 300% implied volatility
unusually high for this, because if it's typically inflated like that and a stock always has a high implied volatility, there's really not too much of a benefit. One of the biggest things that we benefit when we sell options on stocks that have high implied volatility is from something that's called implied volatility crush. And that means a lot of the time implied volatility can get jacked up to these 200, 300% numbers that I was talking about due to certain events or things like earnings that are coming out or company specific news. And we know that only in that small period of time is IV going to be that high. There's only going to be a small window of time when we could sell those options for the premium that we do. And the easiest way to determine that is by looking at IV rank. Again, if we see the IV of 200 or 300%, again, objectively, that's a very high IV. And if we go to IV rank, we'll see, okay, it's at 90%. We know that that's an unusually high IV. It's in the 90th percentile of implied volatility for that stock for the past calendar year. And that's something that we would probably want to jump on in terms of option selling and using one of our put selling or covered call selling strategies. And likewise, if we see a stock similarly high IV, 200, 300%, and we see the IV percent is at 50, we'll know, okay, well, this is kind of normal for the stock. So we can't really count on that implied volatility crush. And another point I want to make about this for implied volatility rank is that since it is based off the last calendar year, you've got to keep in mind context of things that have happened during the last year. So for example, back in February and March, the market absolutely crashed. Implied volatility for these different stocks was through the roof. So looking at IV rank today, when that was in the past calendar year, there is going to be a lot of IV ranks that are on the lower side of things because obviously it would take a pretty big event to match a COVID crash like implied volatility environment. So that is something you want to keep in mind. I mean, a year from now, it'll be a lot easier to look at, provided, God willing, we don't have another market crash like we saw back in February or March. But that is something you want to keep in mind, just context of events and implied volatility measures over the past year as you're looking at and evaluating IV rank. So let's get back to the example that we talked about when we opened this video and see exactly what we're looking at when we sold these covered calls, how it breaks down, and where our profit's coming from to give us the two possible outcomes that we outlined. So like we mentioned when we opened the video, DraftKings was trading at $48.82 and we were looking to sell a covered call position. Looking at the options for options expiring in a week, the $52 strike call looked to be the best combination of both premium and upside as it offered a potential 6.5% gain on the shares and $100 worth of premium in just one short week. Now selecting that option was just a matter of opinion. You could have decided that you wanted more premium and less upside, or more upside in exchange for less premium. Each of those ideas are equally valid and all just depend on your personal risk tolerance and opinion on the short-term performance of the stock. The only thing I will emphasize is that when you sell these covered calls, make sure they're out of the money. We want the entirety of the value in calls that we sell to be extrinsic. To take a quick look at how this would potentially play out, let's jump back into a spreadsheet to run through our potential outcomes. The great part about selling covered calls as opposed to cash secured puts is that you get a gain for both the call you sell and the stock, whereas when selling cash secured puts, you only get a gain from the option you sell. So we'll break this calculation out into the stock gain and the option gain as we run through this trade. All right, so let's take a look at DraftKings exactly like that. We've got the stock gain broken out here and the option gain broken out here. It's trading at $48.82. Our profit right here is going to be calculated as the sum of the stock gain and the option gain. So to start looking at this, let's talk about what happens if this finishes below $52. We know anywhere below $52 that our option is going to expire worthless, giving us a $100 gain on the option. That's going to give us $100 profit, and that could be anywhere below 52. We could trade perfectly flat. It could go up to 51. It could go all the way down to 40. Doesn't matter. We're getting that $100 option gain no matter what. So we know that if it trades flat, we make a profit of $100. Well, what does that return look like? Let's take a look at it in terms of collateral, which we know is going to equal the current price of $48.82 times the 100 shares that we had to buy in order to sell a call. And then our return is going to equal the profit divided by the collateral, which gives us a 2.5% return just off the call that we sold. So what happens if this goes up to 52? We know in this situation that our max profit is anywhere 52 and above. So if this goes to 52, we get a $318 gain on the stock and a $100 gain on the option, which is an 8.56% return in 1 week, which is a huge number annualized. So what happens if this stays flat? We already talked about that. We get 100. If this goes up to 51, we get 218 from the stock, but that's okay because we're still making 318 overall. 6.51% return in a week is outstanding. If this goes to 50, same deal. We just get a little bit lower stock gain. We're always getting this option gain over here. 4.7% return in a week is outstanding. But then that kind of begs the question, well, what happens if DraftKings goes down?
Well, we know since we have $1 of premium, we have $1 of protection. So 47.82 is going to be our break-even price. And we could see that as we break out the calculation and see it down here with the $0 profit. But the good part about that means that we could be wrong about DraftKings going up. It could even go down to like $48. And guess what? We're still making money right here. Even though that's a 0.37 per turn in a week, that's pretty good that we're making money despite being wrong about the stock. And that 0.37% annualizes to a really good number as well. And what happens, this thing could go all the way down to 40, it goes down 10% to 44. Well, we're going to lose a decent amount. We're going to lose 7% that week. We're going to lose $382 as far as dollars and cents on the profit and loss. But you know what? We could do the exact same thing the week after. We could sell another call for a $1 premium. We could get in a situation where we hit max profit again, and that $382 loss is quickly wiped away by a subsequent $418 max profit. So that's just kind of the way that you play it. If it goes your way, you hit max profit, you get those shares called away, awesome. You're going to have an awesome return that annualizes to a great number, and there is nothing to be mad about with that. But if it goes down, guess what? These shares, they don't expire. They're not like options. You're going to have the shares forever. You can just sell another call, and you just keep the train rolling. That's how it works. But that does kind of beg the question of, okay, we've talked about cash secured puts, we've talked about covered calls. Which should I do? In general, I would always recommend starting with cash secured puts, and then if you get assigned on those, you'll have shares that you could then open a covered call position like this. But there are some situations where it is more advantageous to open a covered call than it is a cash secured put. And that's typically when there's a little more premium on the call side than the put side, but we'll address that in a future video. But for now, this is kind of a high-level overview of where the profits derive from, how the stock gain, how the option gain work together to give you a great profit and a great return overall on these covered call plays. So that takes us to the end of our video here on covered calls. We're going to get a little bit more into how we can kind of combine the strategies of covered calls and cash secured puts into what's known as the triple income strategy or the wheel. We have a couple little twists that we like to put on it, so we're going to go over those as well as the general strategy overall in a future video that'll be coming up soon. But for now, thanks for watching. You can give us a follow on Twitter. You can join our Discord server. The link to the Discord server is going to be in the description. That's where we talk about all the plays that we make as we make them and just discuss general strategy. And as always, throw us a subscription if you haven't already on YouTube. If you got any questions, feel free to ask those in the comments. I'll try to address all the comments that I receive. But for now, that's all we got. So until the next time, this has been the Hourglass Trader, where as time passes, we make money.